On paper, the US economy looks pretty fantastic. The stock market's hitting all-time highs, inflation seems to be cooling off, GDP is growing, and yet for so many of us, something just feels off, right? There's this financial anxiety that's just kind of bubbling under the surface. So how can both of those things be true at the same time? Well, let's dive in and try to unravel this contradiction. And this right here, this slide just nails that conflict, doesn't it? On one side, you have the official story, this beautiful, happy chart, celebrating a booming stock market. But then on the other side, you see the lived reality for millions, this crushing feeling of just being buried in debt. It's like two totally different worlds. So, what is really going on? How can these two realities exist at the same time? Well, in this explainer, we're going to peel back the layers and look at three kind of hidden forces that are shaping everything you see and everything you feel. Okay, so the first and honestly probably the biggest piece of this puzzle is that a lot of our so-called economic growth is being propped up by just staggering amounts of debt. It's almost like we've stopped saving for the future and we've just started financing the present. Let's start with the big one, the national debt. It's now over $38 trillion. I mean, it's a number so huge it's almost meaningless. It's hard to wrap your head around. But here's the kicker. Borrowing all that money isn't free. We are now spending $1 trillion a year just on the interest payments. Think about that. That's more than the entire US national defense budget. And hey, it's not just the government. Take a look here. The problem is hitting us right at home, literally. Total US household debt, a record $18.6 trillion. And yeah, you can see mortgage debt is the biggest slice of that pie, but what I want you to notice are the other smaller slices, because those are the ones that are growing much, much faster. You can almost think of all this household debt in three buckets. You've got your good debt, right, like a mortgage, which is an investment in an asset. Then there's bad debt, like student loans, which have just skyrocketed and are nearly impossible to get rid of. And then you have the ugly debt, credit cards. We now owe over $1 trillion on them, with average interest rates over 21%. Ouch. And here's where it gets really, really concerning. It's not just how much debt there is, it's that people are finding it harder and harder to pay it back. As this slide shows, serious delinquencies, we're talking 90 days or more late, they're spiking for credit cards and student loans. We have not seen levels like this since the 2008 financial crisis. That should be a massive red flag for everybody. Okay, let's shift gears to the second layer of this problem. What if the very scoreboards we use to measure how the economy is doing, things like the stock market or the unemployment rate, what if they're actually broken? What if they're not really reflecting reality anymore? So this quote is from Michael Burry. You probably remember him. He's the investor who famously predicted the 2008 housing crash. He recently shut down his hedge fund with this stunning admission that his way of valuing things just doesn't work anymore. When one of the sharpest financial minds out there basically says gravity doesn't seem to apply, you know something has fundamentally changed. And it really seems like the new operating system for the market is something called behavioral finance. It's this idea that markets are now driven less by cold, hard data and more by human psychology, emotion, and just stories. Think about it. Momentum can completely overpower valuation, and prices can go to the moon simply because a narrative, a story, catches fire online. This disconnect isn't just in the markets, it's in our economic data too. We see this big, happy face representing a low unemployment rate. But hiding behind that smile, there are some really worrying trends. It doesn't count the millions of people who've just given up looking for work. And it masks this huge shift from stable, full-time jobs to people having to juggle multiple part-time gigs just to get by. This all brings us to a fascinating idea called Goodhart's Law. The law basically says, when a measure becomes a target, it ceases to be a good measure. Think about that for a second. As soon as policymakers make low unemployment the goal, the whole system gets really good at making that number look good, even if the actual health of the job market isn't really getting any better. And that's a huge reason why the official stats can feel so disconnected from our daily lives. All right, and now for our third and final layer. We're going to zoom way out and look at the big global picture, because cracks are starting to show up in the very foundation of the global financial system. For decades, the world has run on a system built around the US dollar and US debt. But now, other countries are quietly casting a vote of no confidence. So for the last 30 years or so, Japan kept its interest rates at basically zero. This created something called the yen carry trade.
What it means is investors could borrow Japanese yen for practically free, swap it for dollars, and invest in higher-yielding U.S. assets. Japan effectively became the world's ATM, pumping trillions in cheap money that propped up markets all over the globe, including ours.
But in 2024, that all changed. As you can see on this timeline, the Bank of Japan raised its interest rates for the first time in 17 years. This is a huge deal. It signals the end of the free money era. Suddenly, that spigot that fueled global markets for decades is being turned off. The world's ATM is officially closing down. And it's not just Japan. Check out this chart. We're seeing a slow but totally unmistakable shift away from the US dollar as the world's main currency. 20 years ago, central banks held over 70% of their reserves in dollars. Today, you can see that's dropped all the way to 58%. It's not a stampede for the exits, not yet, but it is a quiet, steady tiptoe away from the US. So the obvious question is, where's that money going? Well, a lot of it is going right here into gold. This chart is incredible. It shows a massive, massive spike in gold buying by central banks all around the world. They're not panicking, but they are preparing. They are building a plan B for a future where they're just less reliant on the US dollar. So why does any of this matter to you? Well, as the legendary investor Ray Dalio puts it, the bond market is the backbone of everything. When major buyers of US debt, like Japan and all these other countries, start to step away, that's a big problem. It means we have to offer higher interest rates to attract new buyers. And those higher rates, they affect everything, from the cost of your mortgage to the value of your 401k. Okay, let's step back and put all these pieces together now. When you combine these three powerful forces, the massive debt we have at home, the broken scoreboards we're using to measure success, and those growing cracks in the global financial system, you finally start to understand this economy of contradictions that we're all living through. So here's the bottom line. We have a consumer whose spending is fueled by debt, not by rising wages. We have markets driven by stories and psychology, totally disconnected from fundamentals. We've got official data that hides the real weakness underneath. And we have fading global trust in the long-term stability of the whole U.S. system. And what it all paints is a picture of a system that has consistently chosen short-term gains over long-term stability. A system where every single positive headline, a record-high stock market, strong consumer spending, is ultimately built on a foundation of borrowed money and borrowed time. Which, of course, leads us to the final, unavoidable question. This really complex machine has kept running for a very, very long time. But debt can't just grow to the sky forever. Narratives can shatter in an instant, and global trust, well, once that's lost, it's incredibly hard to win back. So the question we're all left with is, what happens when the music finally stops? What happens when the bill for all of this finally comes due?